Crude oil is climbing again this morning as tensions around Iran grows. And whenever energy markets start moving like this, agriculture pays attention. Diesel, fertilizer, transportation cost, and feed economics all sit downstream from oil. But here's the uncomfortable question producers are starting to ask. If this situation escalates further, do markets rally, or do they actually fall once the event begins? Because the last time the United States invaded a major Middle Eastern country, oil surged before the war began and then dropped once the invasion started. Later in the show, we're going to compare today's situation with what actually happened during the Iraq invasion in 2003 and look at how oil, wheat, corn, cattle, and hog futures behaved before and after the conflict began. First, though, let's map out the board this morning. Looking at the grain markets from the late yesterday afternoon, May corn is trading near $4.46 per bushel. May soybeans are trading near $11.71 per bushel, while Chicago wheat for May delivery is trading near $5.27 per bushel. Corn continues moving sideways inside a narrow band. That mid $4 range has been difficult for the market to break away from recently. Soybeans are holding their footing just above $11, supported by steady demand but not showing aggressive new buying. Wheat remains the most sensitive grain to geopolitical risk. Wheat prices often respond to global instability because of the way wheat flows through international trade routes and food security concerns. Even so, today's board does not show panic. Instead, it shows caution. Traders appear to be watching energy markets and waiting for clearer signals before making bigger moves. If crude oil continues rising, some inflation-driven commodity buying can spill over into grains. If oil stabilizes or retreats, grain markets usually shift their focus back to acreage, weather, and export demand. Turning to livestock, April live cattle are trading near $234.30 per hundredweight, while May feeder cattle are trading near $349.48. These are historically strong price levels for the cattle market. Tight herd supplies and steady consumer demand have kept the cattle complex supported over the past year. However, energy prices play a role here as well. Diesel costs affect transportation, feedlot operations, and the movement of cattle throughout the supply chain. If crude oil climbs significantly and stays elevated, feedlot operators begin to see their operating costs rise. Transportation costs increase, and the economics of feeding cattle can tighten. For now, cattle prices remain strong. While energy costs are a variable the market is watching closely. Lean hog futures for April are trading near $95.78 per hundredweight. The hog market tends to respond more quickly to demand changes than cattle because hog production cycles are shorter. Export demand, feed cost, and consumer spending patterns can all shift hog prices rapidly. Energy costs still influence this market through transportation and processing costs. If crude oil continues rising, those operational costs can increase. At the moment, hog prices appear relatively stable, but they are still part of the broader commodity system that reacts to energy volatility. The central driver behind today's market discussion is crude oil. WTI crude oil futures are trading near $74.80 per barrel. This move higher reflects growing geopolitical risk tied to Iran and concerns about potential disruptions in Middle Eastern and energy supply. The Strait of Hormuz remains one of the most important shipping routes in the world for crude oil. A significant portion of global oil supply travels through that narrow passage between Iran and the Arabian Peninsula. Even the possibility of disruption can push prices higher because traders begin pricing in uncertainty. Higher crude oil prices affect agriculture through multiple channels. Diesel costs rise, fertilizer production becomes more expensive, and transportation throughout the agriculture system becomes more costly. Weather is not a dominant factor in markets this morning. Forecast conditions across much of the central United States appear workable without major national threats to early spring field activity. There are always localized weather issues during this time of the year, but no widespread pattern is currently dominating the market attention. For now, the focus remains on energy markets and geopolitical developments rather than immediate planting delays. Now for the ag news. We're going to start with Iran risk. The current headlines surrounding Iran revolve around escalating regional tensions and the possibility of supply disruptions that could impact global oil flows. Energy traders tend to respond quickly to geopolitical instability because supply interruptions can affect prices worldwide. Even if supply remains uninterrupted, the perception of risk alone can create price volatility. For agriculture, the volatility matters because rising oil prices influence fuel costs, fertilizer production, and transportation expenses. This is why geopolitical events far from American farmland can still influence farm economics. Now let's look at the comparison to the Iraq War we mentioned earlier. During the months leading into the Iraq invasion in 2003, oil prices rose sharply as uncertainty increased. In late 2002, crude oil traded around $25 per barrel. By March 2003, just before the invasion began, prices had climbed to roughly $37 per barrel. That represented a rise of nearly 48% as traders feared supply disruption and regional instability. But once the invasion actually started, supply flows continued normally and uncertainty began to fade. Oil prices then fell back toward $27 per barrel, which represented about a 27% decline from the peak. Wheat followed a similar pattern. Prices rose from roughly $3 per bushel to about $3.60 ahead of the invasion, a gain of around 20%. After the invasion began, wheat prices fell back toward $3.20, a drop of about 11% from the high. Corn and soybeans moved more modestly during that time. Both markets experienced small gains ahead of the invasion and mild pullbacks afterward, as traders returned their focus to normal agricultural fundamentals. Livestock markets also experienced short-term volatility but stabilized as consumer demand remained strong. Here's what's different today. While that historical pattern provides useful context, today's market environment is not identical to 2003. Energy supply chains are tighter, agricultural inputs are more sensitive to fuel prices, and global markets react faster due to modern trading systems. Diesel prices matter more to farm operations today, fertilizer production is closely tied to natural gas prices, and financial markets react to geopolitical news within seconds. This means price reactions can appear more quickly and spread across markets faster than they did 2 decades ago. So here's the big picture. Right now, agricultural markets appear to be watching energy rather than reacting dramatically. Corn near $4.60, soybeans near $11.71, and wheat around $5.27 show caution but not panic. Livestock markets remain strong and hog prices are holding steady. Crude oil near $74.80 indicates that traders are pricing in risk but have not yet reached extreme levels. History suggests that markets often move hardest during the uncertainty phase before a geopolitical event occurs. In 2003, crude oil surged nearly 50% ahead of the Iraq invasion and then declined once the invasion began and supply disruptions did not materialize. Wheat followed a similar pattern, rising ahead of the conflict and easing afterwards. Whether today's situation unfolds the same way remains uncertain, but the historical comparison helps explain why traders are watching energy markets so closely. For producers, the key market to watch right now is crude oil, because energy prices influence diesel costs, fertilizer production, and ultimately farm margins. This is Boots and Bushels, your daily look at the markets that feed America. And right now, markets are under pressure.